Hello friends, last week in my video, I basically hinted to you that interest rates are nearing a top, big money has bitten off a lot of meat and locked in rates at higher levels, and there is a probability that the market senses that rates might be near peak or may have also achieved a peak, and therefore markets could rally, and rally they did. Is this rally likely to sustain and have interest rates confirmed as having peaked? We'll know when the US Federal Reserve meets this week. Let's dive right in and see what the market holds for us. And on your screen right now is the weekly market wrap, which tells you that it was the banking space that dominated the market sentiments and gained more than the broader based Nifty 50. The US dollar index, the Dixie, continued to remain soft, which basically sent out positive vibes to emerging markets, including India, and gold continued to remain steady, whereas silver encountered a little bit of profit taking. Crude oil was a little nervous, whereas natural gas jumped a little under 8%. Indian 10-year benchmark bond yields fell remarkably by 9 basis points, which means the market is betting on a low probability of rate hikes, and bond prices therefore rose, which is again something that cheered banking sector, which is why the bank nifty gained more than the Nifty 50. The dollar fell against the rupee, and what we are seeing is the rupee gaining 18 basis points. NSE gained 2.67% market capitalization. This is another consecutive week of gains in the NSE market cap, so the rally was fairly broad-based. Now, MWPL fell, which is pretty normal after an expiry, and the US markets provided tailwinds to Indian markets by rising across the board. Now we come to our in-house indicators, starting with the MWPL. What we are seeing is that the MWPL in the expiry week is the highest after the December expiry, which was at 22.92. We have closed at 22.65. Pre-expiry at 30.16, it was higher than the prior weeks, the prior month's pre-expiry series itself. So risk appetite has surely grown somewhat. This is the first green flag. The week gone by was the first week after 2 consecutive weeks of holiday truncations, and the last week was the first week to have full 5 trading sessions, which is why the turnover in the stock and index futures was high. But it was really the stock futures that hogged the limelight by rising to a period high of 20 weeks, whereas the index futures turnover also put up a smart gain. So one Marshmallow participation was good. I now come to the advanced decline ratio. Here again, what you're seeing is the percentage gain logged by the Nifty at 2.5% on a week-on-week basis is almost the 20-week high, and the advanced decline ratio, which is the number of shares gaining versus the number of shares falling, has risen smartly to 1.41, which means for every 100 losers, there was 141 gaining stocks. This is an excellent proxy for risk appetite of one Marshmallow traders, and they seem to have shown a higher buying bias. Another green flag. Let's now come to the basis. Basis is nothing but the premium or discount prevalent in the futures vis-a-vis the spot. Now, this is the first sign of concern that I am witnessing. Where the Nifty basis is positive because the traders now have 4 full weeks to play around with before expiry comes in the May series. The bank Nifty basis is actually in the negative, which means the future is trading at a discount to cash. This divergence, where optimism on the Nifty and caution on the bank Nifty, invariably leads to higher volatility. And there is also the market is like a bicycle. You need both the wheels to move together in the same direction. You can't have one wheel punctured or one going forward and one going backward. So monitor the basis very, very keenly. This is something that I put up on my social media accounts every day post market. So keep yourself updated. This is a minor red flag here, but we've had two green flags. So this is one aspect that we'll monitor closely. Now for our exclusive in-house indicator, the impetus that you won't get anywhere. Here again, you're witnessing a divergence. The Nifty has clocked gains last week, but only the Nifty's impetus is up. The Bank Nifty impetus is actually down. Even though the Bank Nifty clocked higher percentage gains on a week-on-week basis, the impetus is down. That means the up move lacked force. Here again, do remember, tally that with the basis which is inverted in the case of Bank Nifty, and you're basically getting a feeling that all is not well. So the impetus is something that we'll watch again on a day-on-day basis. This is a divergence. Both the indices are refusing to move together in unison. I now come to another exclusive in-house indicator, the LWTD, the Lift Weight Thrust Drag Index. The narration of what it is all about by way of a tutorial video is in the description and in the pinned comment below. The Nifty, as indicated by the blue line, has gained 2.5% last week, which is almost the 20-week high in terms of gains. And the LWTD has risen from negative territory in the prior week to 0.26 last week. That tells you that, relatively speaking, I expect improved fresh buying support on the Nifty in the forthcoming week. So that is another optimism, sign of optimism that I'm seeing. This is the third green flag as far as I'm concerned, where the statistical evidence is concerned. Friends, I now come to the bond market, and the bond market is something that I have told you is extremely important. Unfortunately, traders and market participants unfortunately give it very little weightage, but this market is actually the source of all finance for other asset classes. Now, last week we saw the Indian 10-year benchmark bond yield at 7.18, and the week gone by saw 7.11. So I told you that there are indications in my previous video of last week. I told you there are indications that bond yields might be plateauing on the upside. Here again, what you're seeing is, if we crack through the 7.08 threshold and close below it, and the US Federal Reserve makes a move on the 4th of May, and which clarifies its view whether they are raising or they are putting a halt to interest rate hikes, is something we'll know on a very late Thursday night. That will basically indicate as to whether yields have peaked out or not. If yields have peaked out and they even stagnate, the markets could have a slight relief rally. But if interest rate starts to fall, that could be a positive trigger for the equity markets, and that will be the fourth green flag for equity bulls out there. Let's wait and watch. Let's not jump the gun. But what I did tell you last week was I have stopped laddering in sovereign debt, because the new windows of opportunities that I told you had opened in the debt market, where doubled limits in MIS and SCSS were concerned. We have exhausted those and raised allocation in the fixed income market, locked in good rates, and we are now waiting and watching to see rates have peaked out or not. Then we'll take a call on gilt funds. Friends, the bond market's done. I now come to the Bank Nifty, which led the thrust on the upside. It has gained on all 5 trading sessions last week, and it has exhibited a classic rising tops and rising bottoms formation, as you can see on the daily chart on your screen. The price is above a month-long moving average, which basically tells you that the short-term outlook is also positive. The average itself is pointed higher. I wanted the index to stay above the 41,840 level, which it has. which is another green flag as far as the bank Nifty is concerned. Now, going to the weekly chart, the price last week had exhibited a very small bearish candle. But in the week gone by, the bullishness has returned and the upward rally continued. And the 41,840 level acted like a good support below which the bank Nifty did not fall, did not even test it. Price remains above the 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. So the medium-term outlook is also positive. In the week before last, this index was number 5 in the statistical beta list that we maintain in-house of the most volatile counters. And it remained at number 5 last week, which means volatility levels were unchanged and the challenge level for retail traders did not really increase. That's a welcome sign. Last week, I advocated an expected range between 43,525 on the upside and 40,725 on the downside, which held perfectly well. In the coming week, I expect an estimated range between 44,625 on the upside and 41,850 on the downside. Friends, the Bank Nifty done. I now come to the Nifty 50, which gained 2.50% on a week-on-week basis. It gained on all 5 out of 5 trading sessions, as you can see on the daily chart on your screen. And what you are seeing is that the index is getting very close to the 18,115 level resistance, which needs to be broken above, sustainably close above this level, because this is a hurdle that is held in place and the Nifty has not closed above it after 24th of January 2023. So if the bulls manage to take the Nifty above 18,115 and it closes above, that would basically invite the doubting Thomases who are sitting on the fence to come out and buy in larger numbers. Coming to the weekly chart, what we are seeing is that the bearish engulfing pattern that was made in the week prior and the bearish candle had closed at the 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. In my live mint column, I had written that much will depend on whether the bulls are able to make the Nifty trade above the high of the bearish engulfing pattern, in which case a rally would ensue. And if it trades below the low of the bearish engulfing pattern, further falls would be likely. And note how the Nifty has traded above on the weekly chart, above the bearish candle's high, and therefore triggered an up move. So what we do need to see is A, the price maintains its upward trajectory of higher highs and higher lows as per the classic Dow theory, and a sustained trade above the 18,115 on a sustained closing basis, which is not really a very big challenge. Friends, in the week before last, this index was at number 19 in our in-house statistical beta ranking list. It's risen 11 notches to number 8, which means the volatility has gone up. Do remember that the Nifty 50 has seen higher impetus, but the Bank Nifty has seen lower impetus, which is why the statistical beta on the Nifty has risen 11 notches. So challenge level is up. Let's be careful out there. Last week, I advocated an estimated range between 18,075 on the upside and 17,200 on the downside. I would say that this range held, even though the high of the Nifty was at 18,089 levels, which is 14 points higher than 18,075 level that I had advocated. But for a security that's trading above 18,000, a 14-point transgression should not be treated as anything untoward. The coming week is likely to see an estimated range between 18,525 on the upside and 17,600 on the downside. Friends, the Nifty 50 done. I now come to the last bit of statistical studies, which is measuring the risk appetite of a retail trader by their footprint of what contributed as a percentage of the total turnover. Whether it was risky instruments that contributed higher turnover, or was it low risk instruments that contributed higher turnover. That is a qualitative aspect as compared to a quantitative aspect, which is very important from behavioral technical analysis point of view. So on your screen is a daily chart of all the components of the indices and the stock futures and options. The sky blue line that you are seeing represents stock options turnover, which was actually lower. So this is a relatively lower risk instrument. Here the turnover was also low, so traders have actually played elsewhere. Where else? Let's see. The army or olive green line represents stock futures turnover. Here again, the turnover was actually lower. So the focus was clearly elsewhere. The red color line is index futures, and here again the turnover was flat. Let's see now where the index options turnover is. The index options turnover was relatively higher last week as compared to the prior week, and this is the lowest risk instrument. That tells me that sure enough, the bulls are buying, but they are buying the lowest risk instrument. They are buying very carefully because they seem to be a little cautious, which is why there is a divergence in the impetus and in the basis between the Nifty and the Bank Nifty. They seem to be hedging their bets. I would want a higher footprint in stock futures and stock options as compared to index futures and index options, because more appetite for risk would mean improved buying. So we'll continue to watch this in the coming weeks as well. Friends, in this section of what I would do in the coming week, I have a small update for you. I have an unavoidable surgery coming up in the middle of the coming week, and therefore in the pre-surgical examinations and preparations, I will not be participating in the market, and therefore I have no new update about what I will be doing in the coming week. I promise to keep you updated through my social media accounts about when I can get back into active trading again and post all my regular updates. I don't expect any disturbance till Tuesday at least, and whatever has to happen will happen on Wednesday or later. Friends, I now come to the most popular segment of this video, wherein I give you 5 stocks that have gained the most amount of statistical impetus on Friday, where you take small exposure, wait for large price moves, and 5 stocks which have lost the most amount of impetus on Friday, where you take bigger exposure, wait for small price moves. This is not a buy and sell recommendation, but just an indication of which stocks are going to be more and less volatile. The direction will be decided about where the market is going, if it is rising or falling. So that you have to take a call accordingly. This list is valid only for Monday. Only for Tuesday, Monday being a holiday. And for the entire week, I put up this impetus list only on my free Telegram channel. Do join in and stay tuned with whatever research I put up over there. So the impetus gainers list is led by Crompton, followed by Ipca Labs, Syngene, Bajaj Finance, and Indian Oil Corporation. The impetus losers list for Tuesday is led by Infi, Tech Mahindra, AU Bank, Escorts, and Divi's Lab. Friends, I hope our videos are adding a lot of value to your trading experience and making you better traders. Do let me know in the comment section as to how you're benefiting from these videos and what we can do to make it even better. Also, if you haven't subscribed to my YouTube channel, a reminder to do so right away. Click on the bell icon to receive instant alerts about fresh videos being put up out here, and help me reach out to fellow smart investors and traders like yourselves by sharing our videos with your friends and family. I thank you for your patience and sticking with me in this video till we meet again in my next. This is Vijay Bhambwani signing off for now. I wish you have a very, very profitable week ahead. Take care. Bye-bye.